In this video we are going to talk about the extrapolating crypto market crash to equities. So before starting this video, like this video and subscribe to our YouTube channel for future updates. Two significant things happened last week. 1. The market capitalization of all cryptocurrencies fell below levels seen in January 2018 and below levels of $1 trillion, $3 trillion at its high in October 2021. Cryptocurrencies are currently at a 4.5-year low and have fallen by 50% from pre-COVID highs. Bitcoin, which is regarded as a hedge against the central bank's constant money printing, has fallen by more than 70% in just 6 months. You probably already know that cryptocurrencies have plummeted given that the future coin exchanges occupied a large portion of the advertising airspace during the most recent cricket match in India. Second, the Bank of Japan, BOJ, maintained negative interest rates on Friday and issued guidance to keep borrowing costs at current or lower levels. The BOJ feels that Japan's inflation rate is lower than that of the Western nations, which is in contrast to nearly every other central bank in the globe, which is hiking rates. The Japanese yen, JPY, unexpectedly declined after the policy announcement. Theoretically, a nation with reduced inflation should see an increase in its currency, based on buying power parity. Additionally, the JPY has historically served as a stabilizer during times when investors have shied away from riskier assets by barely moving. This leads to a distinct set of issues. A carry trade is triggered when the currency of a nation with lower inflation and interest rates starts to decline. It usually operates in this manner. You might, for example, borrow $1 billion in March 2022 at 0.15% interest and convert it to dollars at the 114 exchange rate that was in effect at the time, equivalent to $8.8 million. You would then invest it at the 2.3% US 10-year rate that was in effect at the time. The US dollar to Japanese yen exchange rate has since risen to 135 since then. The investor who engaged in a carry trade today earned a differential interest rate of 2% while realizing a return on investment of 18%. Theoretically, the currency of the nation with the lowest inflation rate, in this case, Japan, should have a lower interest rate, which is the case, and should experience currency appreciation, which hasn't happened this time. If not, there is free money to be earned on the carry trade, and as we are all aware of or are just now learning, there are no free lunches. The yen carry trade once thrived in the late 1990s, during the cycle of rising interest rates. Everyone was content because the JPY was stable and the BOJ didn't care if a few hedge funds occasionally made a few $1 billion. However, the Fed was forced to decrease interest rates during the 2008 global financial crisis without first preparing the market, which in turn delegitimized the carry trade. Investors discovered the hard way that currencies eventually catch up to interest rate differentials when the JPY strengthened from levels of 120 to 80. It's equivalent to picking up nickels in front of steamrollers to describe the tactic. Until your focus is diverted for a few moments and you lose your hand, you can be quite effective. Since the early 2000s, the scale of the global yen carry trade has decreased by more than 60%, but considering how profitable it is once again, it will be interesting to watch if it ever recovers. Both of these unusual occurrences serve to highlight some important ideas that are crucial to us as equity investors. 1. It's quite easy for things to manifest and last for a respectably long time even though they are theoretically not supposed to. Yes, Bitcoin was designed to act as a hedge against inflation. Yes, the JPY was marketed as a safe haven asset. There is no distinction between theory and practice in theory, but there is in practice. Additionally, events that have never occurred before are occurring often right now. We are destined to be mistaken if our entire frame of reference is based solely on what has already occurred. We will undoubtedly be mistaken if we add leverage to that issue. Before they get better, things might quickly go worse. Second, everything that matters operates in cycles even though our minds like to think in linear terms. After a large amount of time, let's say 30 years, has passed from point A to point B, we often forget the level of volatility and drawdowns that were present. Even now, when we reflect on the COVID-led market fall, the majority of us still see it as a fantastic purchasing opportunity. Almost 2 years have passed since then. As the 2008 financial catastrophe fades from memory, the dot-com boom must also be becoming less clear. Since the monetary policy has been loose for quite some time, many of us will rarely have any experience investing during times of quantitative tightening. We can deal with it if we recognize that A. History has rarely served as a good indicator of how things ultimately turned out in the numerous crises that have occurred over the previous 2 decades, and B. Cycles have always existed, in market caps, in sectors, and in stocks. It's possible that they may become even more apparent now that our investment strategy will need to adapt to the times. My gut feeling is that we would be fine if we recognize those facts and are not financially tethered to path dependence, purchasing something valued at $150 at $100 without it hurting financially if it drops to $80 first. Markets may take some time to stabilize, but we are identifying more and more companies whose value has increased over the past year despite a decline in their quoted price in the markets. Being on the lookout for those is a better use of our time. Private securities platform ADDX, based in Singapore, claimed to be the first financial institution in the city-state to consider cryptocurrency when evaluating the assets of high-net-worth clients. The action highlights how increasingly financial services companies are embracing digital currencies as a way to reach a broad range of investors. According to Singaporean legislation, people who want to become accredited investors must have annual income of at least 300,000 Singapore dollars, $217,991.57, 1 million Singapore dollars in net financial assets, or 2 million Singapore dollars in net personal assets. According to ADDX, it will only accept cryptocurrency assets under the category of net personal assets and will devalue these holdings by 50% for Bitcoin or Ether and 10% for the USDC stablecoin. The COVID-19 outbreak increased interest in cryptocurrencies, which were previously thought of as a niche asset for risk-taking investors. Despite a recent decline in price, the total market capitalization for cryptocurrencies is still $1.2 trillion. A plan that would establish new regulations for cryptocurrencies and give the Commodity Futures Trading Commission the majority of the control was unveiled by a bipartisan pair of U.S. senators on Tuesday, CFTC. Senator Cynthia Lummis of the Republican Party introduced the legislation, one of Democratic Senator Kirsten Gillibrand, one of Congress's most outspoken cryptocurrency supporters, is leading one of the most comprehensive legislative campaigns to date to establish clear regulations for the contentious and fast-expanding cryptocurrency marketplaces. The legislation would mandate that the primary regulatory authority for crypto goods, the majority of which, according to the senators, function more like commodities than securities, would be the CFTC rather than the Securities and Exchange Commission. Since the SEC has often determined that cryptocurrency products must abide by a number of securities requirements, the smaller CFTC is generally regarded as a friendlier regulator for cryptocurrencies. With the midterm elections just a few months away, it is unlikely that the bill will be passed into law under the current Congress. Nonetheless, its general outline might serve as a starting point for discussions about how to regulate those markets in the future. Regardless of whatever party holds control of the House or the Senate, according to Cowen Washington Research Group analyst Jarrett Seiberg, we anticipate that this bill will serve as the starting point for debate next year. Even though the specifics are sure to change, it matters that there is a bipartisan attempt to integrate cryptocurrency into the current regulatory framework. The senators claimed that in addition to offering consumer protections, the law aims to give crypto markets confidence and transparency. The law would, among other things, create new regulations for stablecoins, which are tokens designed to have their value linked to a conventional asset like the US dollar. Following the value collapse of the well-known stablecoin Terra USD, those items have recently come under intense attack. According to the new legislation, stablecoin issuers must have liquid assets of the highest quality equal to the value of all issued stablecoins and publicly report their holdings. What do you think about this video? Do let us know down in the comments section below. If you enjoyed this video and want to hear from us again, be sure to hit that subscribe button before you go.